Carmignac. Frederic, thank you so much for having us a few minutes in Negocios Televisión. Can you hear me now?
Yes, better, a bit better.
Okay.
But don't speak too fast because the sound is a bit tricky.
Okay, perfect. We will try to do the interview with this sound and this volume. I would like to talk about the ECB accounts that have been published today, showed the debate over the speed of policy tightening and which side, from your point of view, hawkish or dovish, do you think will win on this discussion? And today we heard Luis de Guindos saying the ECB must unwind stimulus gradually and with caution, given the presence of exceptional uncertainties.
Yeah, so what we understood from the minutes today is that clearly we have 4 hikes coming at each meeting from July till the end of the year. In fact, it's not a very good news because we know that these hikes will come at a time when the economy is slowing down. But the ECB has a clear mandate with 7.5% inflation on average in Europe. It has to do something. What we understood also today is that of course, you have a very big inflation coming from energy prices, but you also start to see core inflation going up gradually. And we also heard about, and the ECB heard about discussions regarding wages at several levels and several companies that show that wages are going to climb. So in this context, and even if you know that a slowdown is coming, you are the ECB, you have to tighten. And globally, we can see that these 4 hikes are integrated in the price of the bonds now. So there shouldn't be any new negative surprise. The bad surprises could come from either a sharper slowdown than expected, which would make these hikes even more exogenous, or you will have freight because you will see inflation even stronger than expected. So we are in a very difficult part of the short-term cycle where the fears come from too high inflation, too weak economic growth. It's very complicated to manage, and it explains also why the stock market as a whole has been weak recently. Nevertheless, when you compare the weakness of the European markets to the US market, you can find that there is some good resilience here, which might be somehow surprising.
And if we look at the US, today, Sir George from the Fed of Kansas City says Federal Reserve will succeed in bringing down inflation. But how much tightening will be needed to make that happen?
So the first answer I would like to do is now is always the same. It is that for the past few years, the central banks were deciding with the markets what to do with interest rates. And now it's clearly inflation that is the boss at the Fed and at the ECB. And so I would say, and that's about what the central banks say, they don't know exactly where the neutral rate will be in the coming weeks or months. But for the time being, I think we still expect the end of tightening at the end of this year. And so 7 hikes, 6. But we don't know. It all depends on inflation. We believe that a local peak in inflation has been hit at 8.5 last month. But we still might have surprises and see a surprising resilience from inflation staying above 8 for some time. And in that case, I think that the Fed would probably have to implement more rate hikes, and also the fixed income market would have to integrate more hikes in the future. You know, the inflation now is deciding, and it is very important to say so because it is the first time since many years that inflation is the boss at the central bank. We have lots of surprises because we see a very strong job market. That's clearly the case in the US, but even if you look at Europe, many European countries are close to, let's say, almost full employment. And it's new for many of them. It explains that the equation on wages will be pushing inflation higher in the coming months. And that's why I think it's very difficult to know where this stops. But what we have to take into account is that the Fed and the ECB have a clear mandate. And the most important aspect of the mandate is to make sure that inflation doesn't get out of control. And if they don't act very forcefully, inflation could very much go out of control. Even at all costs, I would say, even if they see that it will create a recession, which is very likely in Europe, they will do it because that is their mandate. And that's where we are now. So it's clearly a very different environment from what we got used to over the past 10, 20 years. It's very different. And if you allow me, I think that we also have to take into account that it is not only a short-term inflation coming from the exit of the COVID situation or coming from the Ukraine war. It's also inflation that comes from the fact that very long-term trends that have suppressed inflation for years are now reversing. You see demographic trends, which lead to less savings, more consumption, that is to say, more inflation. You see the e-commerce prices that have started to go up, and over the previous years, they were a big contributor to deflationary prices. You see also the global trade, which has stabilized in terms of volume. It doesn't grow anymore, which means that specialization doesn't increase, and prices at the end of the day will have also to increase. And if you add to that all these questions regarding reshoring activities in order to get rid of the dependencies upon the foreign countries, it's another reason to anticipate further inflation. And I think that the central banks are clearly understanding now that the fight will be tough and that it will last. So the surprises are ahead of us. My view is, on the longer term, we will be surprised by the duration of inflation. There will be ups and downs, but in a long-term positive trend. The same way we had during the years 1965, 1980, a big inflation trend, which was not negative for growth, but not very positive for the markets. It's probably the kind of situation we are emulating now. And I would say the COVID exit was the trigger for this situation, but now the long-term trends will support inflation for the coming years, and so it will be very difficult to see the end of this fight. At the end of the day, we have to get used to inflation rather than fight it at all costs, because fighting it at all costs will destroy growth totally without preventing inflation from going up at the end of the day. So we have to get used to it and to see what we have to do to make sure that we can have growth with inflation and at the same time preventing inflation from getting out of control. That is clearly the mission for the central banks in the coming years. It will be very interesting. It means many things in terms of what you have to invest on, what you have to avoid. But for the past 12 years, it was the only place to be were the growth stocks. Now you have to think of value stocks, cyclical stocks, industrial names, oil producers or energy producers. These stocks were hammered by low interest rates. Now they will strive in a rising rates environment. There are many implications coming from this long-term inflation reversal. And the central banks still have to learn how to act against this trend.
It's a challenging situation for central banks. And last question, it would be about considering this. current scenario, investors are increasingly growing nervous that economies are set to fall into a recession. How can we prepare our portfolio for this scenario?
Yeah, the recession in Europe clearly is possible. Does it mean that as soon as now we should buy duration on the fixed income markets? Probably not, because we also know that inflation will not peak before September. So it's probably too early now to say, I want to go long fixed income because recession is coming. Is probably a bit too early. You can have a recession which is also inflationary, which means that it's not the same kind of slowdown as the ones we had during the previous 20 years. So that's my first answer. The second one would be, of course, you shouldn't be exposed 100% to equities. You should focus mainly, of course, on consumer staples, the very defensive part of the stock market. And probably, depending on what is happening on the energy front, be long energy producers, whatever energy we are talking about. But I think that inflation will stay for some time due to energy prices, which themselves will depend upon the fact that Europe has decided to make sure that the energy transition will be very quick and probably a bit too quick, which means that the price of energy, because of this decision, could stay very high. And in that case, the portfolio would be being long energy on the one hand, and being long very defensive companies like consumer staples on the other hand, building what we call a barbell in order to make sure that the portfolio is well balanced. And the idea also would be not to put too much of your money on the stock market, because this environment is very full of uncertainties. And so we really have to be careful. And at some point in the future, of course, you will make money on your cash. And also it's the first time for years that you will be able to make money with your cash. And I think it is part of the portfolio we have to build for the coming years.
Thank you so much, Frederic Leroux from Carmignac, for this analysis. A pleasure.
My pleasure.